So let's jump right into to talk about ways in which you can get your benefit and how you qualify for your benefit. So first of all, the way that you qualify for Social Security benefits is you must earn at least 40 credits, and to qualify as work, you must have earned reported income and paid Social Security taxes on that income. So for instance, in 2017, you must earn $1,300 in covered earnings to get one Social Security credit. And you can earn credits throughout the year, or you can earn enough money in one quarter, such as earning $5,200, which would be 4 credits worth, to get the maximum 4 credits for the year. So you can earn 4 credits a year. So it'll take 10 years to earn the required 40 credits, which you would need to require to earn a Social Security benefit. So that's how you would qualify for a benefit. Let's take a look at how they will calculate your benefit. The dollar amount of your benefit is based on your lifetime earnings. Your actual earnings are adjusted, or what they call indexed, for inflation to account for changes in the average wages since the year that you earned that money. And the size of your benefit in retirement depends on how much you earn during your working life. So Social Security keeps a record of how much you made every year up to a ceiling each year. So for instance, in 2017, that ceiling is $127,200. So any amount you earn over that, you don't pay Social Security taxes on that money, and it's not factored into the calculation. So each year over time, that amount has been increasing based on regular inflation. So for this year, it's $127,200. And then what they will do is Social Security will then calculate your average index monthly earnings during the 35 years in which you earn the most, and applies a formula to those earnings to arrive at what they call your basic benefit, or your primary insurance amount, or your PIA. We'll talk a little bit more about that later. So the important part is that they always do look at 35 years of earnings. So sometimes people will ask, well, you know, I only worked for 30 years, so will they just take those 30 years? The answer is that since they always look at 35 years, they will factor in a 0 in any years where you didn't have earnings to get you up to 35 years. So if you only work for 30 years, they'll have 5 years of zeros in there. And when they arrive at that primary insurance amount, that's how much you would receive at your full retirement age, which we will get into what that means for people based on your birth date in just a few minutes. So finally, the age at which you claim your benefit will ultimately determine your monthly benefit. So occasionally people will say later in their career, with maybe they're getting ready to retire and they might go down to part-time work, people will ask, well, will that affect my benefit by earning less money in the later years? And the answer is no, it won't impact your benefit to make it less. It will only help you, because if you earn less than you had been earning, but you still earn enough that it might bump out one of the lower earning years over your career, then it'll be added into one of the highest 35. If it isn't one of the highest 35, then it just won't be factored into your formula, and it won't impact negatively what your benefit would be. So I mentioned full retirement age, and what that means is Social Security has a table where they determine a person's full retirement age, which is important because that's the age at which you would earn your full benefit. So looking at this chart here, you can see that it's based off of your year of birth. So for birth years of 1943 to 1954, your full retirement age is 66. And the third column over is the amount that you would receive at age 62 if your primary insurance amount was going to be $1,000 a month. This would be the amount that you would receive at age 62, which is the earliest age that you're able to claim a benefit. So for instance, if someone's full retirement age was 66, and they were going to receive $1,000 a month at age 66, their benefit would be reduced by 25% if they started to claim their benefit at age 62, and they would receive $750. You can see once you get into 1955 up to 1960, the full retirement age changes, and 2 months are added to age 66 for each year in between 1955 and 1960, at which time the full retirement age climbs all the way up to age 67. And if you claim benefits at 62, when your full retirement age is 67, you'll actually have a 30% reduction, so $1,000 a month benefit would go down to $700. And 2017 is actually a key year in all this, because that's the first year when we start to see people with a full retirement age that's later than 66 that are first eligible to claim benefits, and that's because people born in 1955 turn 62 this year, and they're eligible to claim benefits, but their full retirement age is 66 in 2 months. So they would have to wait a little bit beyond their 66th birthday to reach their full retirement age. So let's talk a little bit more about how when you claim matters to the amount of benefit that you would get. So we talked about age 62 a moment ago. That's the earliest that you're able to claim a benefit, but as we mentioned, your benefit could be reduced by 25% if your full retirement age is 66, or it could be reduced by 30% if your full retirement age is 67. So the key thing there is that that's a permanent reduction. So you're getting your benefits a little bit earlier, but the benefit is reduced, and that's a permanent reduction that would kind of stay with you for the rest of your life. It doesn't, if you, for instance, if you claim at 62, once you reach full retirement age, they don't bump up your benefit. When you claim early and you get that percentage reduction, that reduction stays with you forever. Now, at your full retirement age, you would receive 100% or your full benefit. And we talked about how that depends on your year of birth. So it's important to just be aware, if you're born between 1955 and 1959, that there would be a couple of months added in there. So it's not necessarily 66, it could be 66 and a few months. Now, what happens if you wait and claim after your full retirement age? Well, the good news there is that you can receive what's called delayed retirement credits. And what happens there is, for each year that you delay claiming benefits after your full retirement age, your benefit amount is increased by 8% per year. And that's a permanent increase, and it maxes out at age 70. So let's say your full retirement age is age 66, and you are going to receive $1,000 a month. If you wait till age 70, your benefit would be 132% of your full retirement age benefit. So if you were going to receive $1,000 a month at age 66, you would get $1,320 a month at age 70. And those benefits is just a straight 8% per year increase. So let's say you claimed at 68 instead of full retirement age of 66, then 16% would be added to your benefit amount. So it's important to just understand that by claiming early, you get a little bit less, and by claiming a little bit later, you'd get more. And to see how this works and how these are all related to each other, this chart does a good job of sort of showing the differences in what you could do by either claiming early or claiming later. So looking at the bar in the middle, you see if someone were to be receiving $1,000 a month at age 66, if their full retirement age was 66, we talked about the reduction, how that would go down to $750 a month at age 62. But what would happen if you waited till age 70? Well, I mentioned it would go all the way up to $1,320 a month. So the difference there can be a lot per month. So, you know, the age 70 benefit is actually 76% higher than the age 62 benefit. So it's just important to understand the interplay between the benefit amount and what your claiming age is and how that affects what you'll get each month. So we've talked about how you can qualify for your own benefit and how that benefit amount is calculated, but what about other people receiving benefits off of your working record? We'll talk a little bit about that, starting with the spousal benefit. So a long time ago, when Social Security was first put into place, the rules were such that in many cases, to recognize the fact that in a lot of instances, one of the spouses worked and maybe the other one didn't. So in order to provide a benefit for the working spouse and the non-working spouse, the rules were written so that there was a spousal benefit. This benefit was based off of the worker's record. So as long as the worker qualified for their own benefit, once they claim their benefit, then a spouse, even if they were not working and didn't qualify for their own benefit, the spouse could receive the spousal benefit. A spouse can also start to claim that spousal benefit at age 62 or older, and they must be currently, the spouse must be currently collecting their own benefit. So let's say, for instance, that the husband was the worker. The husband would have had to have claimed their own benefit to trigger the availability of the spousal benefit. And the spouse can start claiming that spousal benefit as early as age 62, just like the worker benefit. They must be legally married to the worker that has claimed their benefit at the time that they apply, and they must have been married for one continuous year prior to applying for the benefit. Now, a quick note on this, and we'll get into this in more detail in just a few minutes, but if you were born before January 2nd, 1954, and you had already reached full retirement age, which would be age 66, you can choose to receive only the spouse's benefit and delay receiving your own retirement benefit until a later date. If your birthday is January 2nd, 1954 or later, the option to take only one benefit at full retirement age is not available anymore. So if you're born after January 1st, 1954, if you file for one benefit, you'll effectively be filing for all of the retirement or spousal benefits that you're eligible for, and you'll just get paid the higher of the two. So I'll cover that in more detail in a few minutes when I go over the new rules that went into effect last year. So how much would a spouse receive if they're just claiming the spousal benefit off of a worker's record? They're eligible to get up to 50% of the spouse's full retirement age benefit if the spouse themselves claims that benefit at their own full retirement age. So what that means is if the worker has already claimed their benefit, if the spouse waits until their own full retirement age, let's say 66, if the worker was to be receiving $2,000 a month and the spouse waits till age 66 to claim the spousal benefit, they would get $1,000 a month or 50% of the benefit. And just like we talked about a worker who claims their own benefit early, how their benefits reduced, the same is true for the spousal benefit. So if a spouse claims the spousal benefit prior to full retirement age, they'll receive a little bit less than 50% of their spouse's benefits. So for instance, at age 62, if a spouse claims, they would receive 35% of the worker's benefit instead of 50. If they claim at 65, which is just 1 year prior to full retirement age, you can see they would receive 45.8% of the worker's benefit. So it'd be about a 4% reduction for claiming 1 year early. So in this slide, this example assumes that full retirement age is just straight 66. But an important note here is even if the spouse claimed their own benefit early and their benefit is being reduced, if the spouse waits to their own full retirement age, you can still get 50% of their benefit by claiming a spousal benefit at their own full retirement age. So how would that work? Let's say a worker was to receive $2,000 a month at their own full retirement age, but they claimed at 62 and they were reduced by 25%. So instead of $2,000 a month, now they're receiving $1,500 a month. But their spouse waits till age 66 to claim the spousal benefit. Well, they would still get 50% of their spouse's full benefit, which in this case was the $2,000 a month is the full benefit. So they would receive 50% or $1,000 a month, even though their spouse was getting $1,500 because they claimed early. So the spousal benefit is important because it'll be based off of when the spouse claims that benefit and not necessarily based off of when the worker claims their own benefit. Now, what about ex-spouses? So married spouses can receive that spousal benefit, but ex-spouses are also eligible to receive a benefit. The marriage must have lasted for at least 10 years, and you have to be not remarried to claim the ex-spousal benefit. You have to be age 62 or older, and the ex-spouse has to be entitled to a Social Security benefit, and your own benefit would have to be less than the benefit you would receive as an ex-spouse. So what that means is if you have your own working record and you qualify for Social Security, you would only get the ex-spousal benefit if it was higher than your own benefit. So just like the married spousal benefit, the ex-spousal benefit is equal to a maximum of 50% of the ex-spouse's full retirement age amount if the individual claims this ex-spousal benefit at their own full retirement age. Just as is the case with the spousal benefit, the ex-spousal benefit would be reduced if it's claimed early. Now, one key difference between the current spouse, married spouse benefit, and the ex-spouse benefit is we talked about with the married spouse benefit, the other spouse has to actually have claimed and been receiving their own benefit in order for the married spouse to get the spousal benefit. However, with the ex-spouse benefit, the worker whose benefit that this is based off of doesn't actually have to have claimed their benefit, but they have to at least be age 62. So if they're eligible to claim a benefit, even if they haven't claimed, the ex-spouse can actually claim that ex-spousal benefit off of that worker's record. So that's one key difference between the spousal and the ex-spousal benefit. How about the survivor benefit? So if an individual becomes a widower or widow, they would be eligible to claim what's known as the survivor benefit off of their deceased spouse's benefit. So the key difference on the survivor benefit is that can begin a couple of years earlier. So you can begin to receive the survivor benefit at age 60. And in this case, it would equal 100% of the deceased worker's benefit when a survivor claims at their own full retirement age. So, however, if a reduced benefit was being paid to the individual that passed away, then that survivor benefit is based on that amount. So just like we talked about with the spousal and ex-spousal benefit being reduced if it's claimed early, the same is true for the survivor benefit. So if you claim at age 60, which would be the earliest, then that benefit would be 71.5% of what the deceased spouse was receiving. And that percentage goes up all the way up to right before your full retirement age, where it gets up to 99%. And then once you reach full retirement age, if you claim the survivor benefit, it would be 100% of what the deceased spouse was getting. Now, the important thing to remember here is if you were if both spouses were receiving their own benefit and one spouse passes away, if that surviving spouse jumps over to receive the survivor benefit, then their own benefit would drop off. So you wouldn't receive your own benefit and a survivor benefit. You would either stick with your own benefit if it's higher, or you would switch over to the survivor benefit of what the deceased spouse was receiving. So that's a key thing to remember associated with the survivor benefit. Now, in order to qualify for it, you must be married for 9 months prior to the individual passing away. And as I mentioned, you would collect your own or the survivor benefit, but not both. And if the surviving spouse had been receiving their own benefit, as I mentioned, it would drop off if it's the smaller one. Now, a key thing to remember is that the survivor benefit can be claimed independently of one's own benefit. So if a spouse passes away and you have your own benefit as the survivor, you can collect the survivor benefit, and you would be able to let your own benefit continue to increase. So they're looked at as two separate benefits. So your own benefit would accrue and potentially receive the delayed retirement credits after full retirement age, and that's a key planning opportunity. So let's say you might be beyond age 60, and if you become a widower or a widower, you'd be able to start receiving the survivor benefit. It could be reduced if you're younger than 66, but the key thing is you could let your own benefit accrue, and it might become higher at a later age, and you can just claim the survivor benefit while your own benefit remains untouched. So unlike the spousal benefit, when you claim the spousal benefit, you would automatically get the higher of your own benefit or the spousal benefit. But with the survivor option, you can actually just say, I only want the survivor benefit right now, and I'm going to let my own benefit accrue and become higher and claim it at a later age. So that's a key takeaway with the difference between the survivor benefit and the spousal benefit. Now, others can also collect the survivor benefit as well. So even if a surviving spouse was younger than age 60, if they are currently caring for any children that are under age 16, then the surviving spouse would get a benefit up until when those children turn 16. Any unmarried children would also receive a survivor benefit provided that they're younger than 18. So at age 18, those survivor benefits would stop for any unmarried children. Now, what happens if you are a survivor and you are remarried? There would be no survivor benefit available if the surviving spouse remarries prior to their own age 60. But if they remarry after age 60, the survivor benefit is not impacted. So if you're a widower and you become remarried after age 60, you would still be able to receive that survivor benefit. However, if you become remarried and your current spouse is receiving Social Security benefits, you may want to apply for spousal benefits from that new spouse if that is higher than what you'd be getting from the survivor benefit, because you would receive the higher of the two. So the key thing there is, even if you're eligible to keep receiving a survivor benefit, if you do become remarried, you may be able to get a higher benefit off of your current spouse. Now, let's take a few minutes to talk about some of the rule changes that were put in place in 2016. So in November of 2015, President Obama at the time signed a important act known as the Bipartisan Budget Act of 2015. And what was key about that act is the new regulations really changed Social Security planning for many retirees. The changes mainly affected two strategies that helped retirees increase their lifetime benefits. Together, the two strategies that are known commonly as file and suspend and the restricted application, they allowed retirees to claim income from their benefits presently and then claim more or higher benefit later. So let's first look at the file and suspend rules, which basically refer to a method of claiming benefits which allows someone who has reached their full retirement age, which is currently 66, it allowed them to file for their own benefit and then immediately suspend those benefits. The primary purpose of doing this under the old rules was to trigger the availability of the spousal benefit by starting their own. However, by suspending their own benefit, it meant they would now start to receive those delayed retirement credits that I talked about, and their own benefit would increase by 8% per year. But by claiming, it allowed the spouse to start getting the spousal benefit off of their record. So it was sort of a, have your cake and eat it too. You could claim your benefit and let your spouse start to claim the spousal benefit, but immediately suspend it, and then your own benefit would start to receive those delayed retirement credits. Now, the Act provided a window of time in 2016 to be able to take advantage of what the old rules were. But after April 29, 2016, if a person suspended their benefit, they would have had to be full retirement age to do that. But any benefits that were tied to that record, so spousal benefits, child benefits that we talked about, they would also be suspended. So, however, if that primary benefit recipient were to start receiving their benefits again, then any other suspended benefits would also be paid once again. So the key is, if you file and suspend after April 29, 2016, every other benefit that's tied to that benefit would also stop. So it really kind of took away a lot of the good features of being able to suspend your own benefit. So, but something else was impacted by this rule too, and another feature within the file and suspend rule that was impacted was the ability to request a lump sum. So for those that were eligible to file and suspend prior to April 29th, they would be able to preserve the right to request a lump sum payment of their benefits during that suspended period. So for example, let's say you filed and suspended benefits at age 66, so you could boost your own benefit with those delayed retirement credits. But let's say 2 years into that, you decided you wanted to collect your benefits. So you could either start collecting benefits at that time, and you would have received 2 years of the delayed credit, so now your benefit would be 16% higher since it's 8% a year. Or you could actually have requested a lump sum payment of the 2 years worth of benefits that hadn't been paid to you during that suspended period. So in that case, you would have received a lump sum, but then Social Security will now pay you a benefit as if you had started at age 66. However, the important thing to note now is that the new law prohibits that lump sum payout option. So for anyone who files and suspends after April 30th, 2016, you won't have that lump sum option. So file and suspend didn't go away, but it just doesn't have the same benefit as it used to. So going forward, there's really only one reason to file and suspend, and that's really to increase your own benefit if you had claimed early. So for instance, let's say someone claimed their benefit at age 62, thereby receiving only 75% of their full benefit. Because remember, retiring or claiming at 62, you would have a 25% reduction. So let's say at age 66, they're now eligible to file, or they're eligible to suspend. So remember, you have to be full retirement age to suspend. So you filed at 62, your benefits were reduced, but at age 66, you can say, you know what, I'd like to suspend my benefit. And by doing that, they would stop receiving their monthly benefit, but you would now begin to accrue the delayed retirement credits that kick in at full retirement age. And for every year that you would wait at that point or suspend benefits, 8% would be added to their benefit. So let's say that they delayed up till age 70, the benefit would have increased by 32%. And what that really means is if you claimed at 62, say, you were reduced by 25%, and then at 66 you suspend and you wait all the way till 70 to start collecting again. Effectively what happens at that point is you can get your benefit back up to almost what it would have been if you had claimed at 66. So you'd basically be receiving 99% of your full retirement age. So it's a little bit of a do-over. You claim at 62, you suspend at 66, and you reclaim at 70. You'll basically then get what you would have got if you started your benefits at 66. So file and suspend is still there. It just doesn't have the same benefit as it used to for the spouse to start getting benefits, but it can actually help the individual make their benefit a little bit higher if they want. Now, the restricted application is another method of claiming that has been impacted by that legislation that went into effect last year. And unlike file and suspend, which will still be available, but as I said, it lost a lot of its initial appeal with the new rules, the restricted application will actually eventually be completely phased out. So filing a restricted application allows a person who has reached full retirement age to claim a spousal benefit only. And note, for that to be available, the person's spouse must have already been getting their own benefit. So the primary reason to file a restricted application at full retirement age has been to collect a spousal benefit only while letting their own benefit grow at 8% a year. So remember, you have to have been full retirement age to raise your hand and say, hey, I only want to file a restricted application. So at that point, you would only be getting the spousal benefit, and your own benefit would accrue the 8% a year bump up. And it was a way to collect a spousal benefit that otherwise would have gone unclaimed if the two spouses just claimed their own benefit, but it would be a way to just claim a spousal benefit while letting your own benefit become higher and receive those 8% a year bump up. So, you know, someone might say, well, why would you just claim a spousal benefit if it's less than your own? And, you know, the answer would be, as I mentioned, that spousal benefit might have just gone uncollected if you had started your own benefit. So the spousal benefit might be lower, but you might say, well, I'll claim 4 years of this spousal benefit, and then when I switch over to my own at age 70, my own benefit will be, you know, 132% of what it would have been at 66. So this was sort of an unintended loophole that was available in the whole claiming rules, and the new legislation was put in place to really take away this impact. A lot of what was happening by the availability of that rule was really having an impact on the amount of money that was available in the Social Security Trust Fund, and it was sort of serving as a way to further deplete that trust fund for benefits down the road in the future. So that new rule was put in place to impact how one could claim the restricted application. So the important thing to remember with that is the new legislation provides the ability for to file a restricted application only to those people born prior to January 2nd, 1954, or in other words, people who turned 62 in 2015, which actually includes a date of birth of January 1st, 1954. So filing a restricted application is unavailable to anyone born on January 2nd, 1954 or later. So since you have to be full retirement age in order to file a restricted application, and people who qualify based on their date of birth are grandfathered in to be able to do this, even though they aren't yet full retirement age. The rule will be in effect for those people until really January 1st, 2020, when the youngest people in that grandfathered group will finally reach their full retirement age of 66. So that rule will be available for a few more years for those that were born prior to January 2nd, 1954, and then really by the end of 2019, that will be completely phased out. So remember, people who have already filed in suspended or filed claims for a restricted application are grandfathered, and they will not be impacted. So for people who have already done that, they could take advantage of the new rules or take advantage of the old rules, and then after that, the new rules take effect. So what happens if you are working and still earning money while you are claiming benefits? So there are people who like the idea of claiming at age 62, but they might be still working. So a couple of things happen. First, by claiming at 62, your own benefits are reduced, as we talked about earlier. But if you're still working, there are some rules associated with what will happen with your benefit. So this rule comes into play for anyone working while receiving Social Security benefits. So for the years prior to your full retirement age, if you earn more than the threshold amount, which in 2017 is $16,920, you'll lose $1 of benefit for every $2 you earn over that threshold. So how does that really work? So let's say that you are 62 years old and you're receiving Social Security benefits. Assuming you work and you earn $26,920, I'm using the easy math. So if you earn $26,920 in 2017, which is exactly $10,000 over the earnings limit, that means $5,000 will be deducted from your benefit. So remember, it's a $1 deduction for every $2 over the limit. So if you earn $10,000 over the limit, $5,000 of your benefit will be taken away. Now, how does that actually work? So let's assume that your Social Security benefit that you were receiving was $1,000 a month, and now because of this penalty, $5,000 of your benefit is taken back. So if you're getting $1,000 a month, Social Security will withhold your first 5 months of benefits until they have withheld that $5,000, and then they will resume your benefit payments for the remaining months of the year. Now, the rule changes for the year that you reach full retirement age. So let's say you're going to reach age 66 in June of a year, or really any other month. But beginning in January of the year that you turn full retirement age, the rule changes slightly. So for the months of the year before you reach full retirement age, you can earn up to $44,880 without having your benefit reduced. If you earn more than that prior to your full retirement age, $1 in benefits is deducted for every $3 you earn above that amount. And then once you reach full retirement age, the earnings cap does not apply anymore, and you can earn any amount without having your benefit reduced. So let's say your birthday is earlier in the year. Let's say it's in March, and from January to March, maybe you only earned $40,000. That would be under the $44,880, and then in March you turn full retirement age, and at that point the penalty doesn't apply, and you can earn any amount from that point forward. So after your full retirement age is reached, you can earn any amount in a given year, and your benefit won't be impacted at all. Now, the important thing to remember is that Social Security benefits that are withheld prior to full retirement age due to exceeding those earnings cap, they're not lost forever. When you finally reach full retirement age, your benefits are recalculated and the percentage that your benefit is being reduced by is lowered. So essentially, any of those benefits that they withheld while you were working and receiving over those earnings cap, they refactor your benefit and they start paying you back that money. So it's not lost forever, it's just withheld. So to illustrate how that works is, let's assume you claim Social Security at age 62 and you're still working and you've had benefits withheld due to exceeding the earnings limits. When you reach full retirement age, they'll actually look at the total benefits that have been withheld. And let's say you've had the equivalent of 12 months of benefits withheld. Social Security will then recalculate your benefits and make it so that you first claimed your benefits at 63 instead of 62. So if you claimed at 62 and they look at it and say, wow, we withheld the equivalent of 12 months of benefits. So now we're going to recalculate this individual's benefits and say they will recalculate their benefits to have it be as if you claimed at 63 instead of 62. So essentially they're reducing the penalty for claiming early because they had previously withheld benefits that they're now giving you credit for again. So that formula can be a little bit complicated, but the key takeaway there is if you do have benefits withheld because you worked prior to full retirement age and you were getting Social Security benefits, they'll recalculate that and essentially pay back those benefits. Now, there's a couple of key provisions that come into play for folks who qualify for Social Security benefits, but maybe they also have a job where they did not pay into the Social Security system at some point. So individuals who kind of had two different jobs in their career where one they paid into Social Security system and maybe another job where they did not. So if this provision applies to an individual, it only impacts a person's own retirement benefit. It doesn't impact them if they're going to receive a spousal or a survivor benefit. So although the first one is the windfall elimination rule, which if the rule applies, it can reduce the amount of a Social Security benefit, but it cannot eliminate it completely. And in fact, in 2017, the maximum reduction that can be imposed by this rule is $443 per month. So that amount changes a little bit from year to year. And additionally, the reduction that's imposed by this rule is limited to a 50% of the person's public pension. So therefore, if someone was receiving a government pension of, say, $600 a month, their Social Security benefit would not be reduced by more than $300 per month. So it can only be either a reduction of 50% of what the public pension is, or up to a $443 a month reduction. So again, the key takeaway here is if the windfall elimination rule kicks in, it only affects a person's own benefit. But if they were to be receiving a spousal benefit, or eventually if they become a widow or widower and they're getting the survivor benefit, this rule does not impact that. However, there is another rule that kicks in to play that does impact the survivor or spousal benefits. So some people, usually civil service employees, they don't pay into the Social Security system, but rather a civil retirement system. And in that case, since the years of employment would not be recognized by Social Security, as a result of this, they would be entitled to receive a spousal or survivor benefit, but it could be impacted. So Social Security will offset those benefits as a result if this individual is entitled to a pension from work that was not covered by Social Security taxes. So essentially what would happen is Social Security would reduce any spousal or survivor benefits by 2/3 of the pension that that person would be receiving from their civil service. So you would receive your full civil pension and any additional spousal or survival benefits if they exceed 2/3 of your pension. So this can be a little bit complicated, but let's look at an example of how this works. Let's say in our example that the husband had a job where he did pay into Social Security system and was eligible to receive a Social Security benefit, but the wife in this case had a government pension from civil service work. Let's say that the wife's pension was going to be $1,500 a month, so the government pension offset would be $1,000. As we said, it's 2/3 of their monthly civil service pension. So if they're going to receive a civil service pension of $1,500, the government pension now is $1,000. And the way that factors in is, let's say the husband's Social Security benefit was going to be $2,400 a month. The spousal benefit would have been up to $1,200 a month if claimed at 66, because it's 50% of what the husband was getting. So it would be $1,200 a month, but because the government pension offset is $1,000, the spousal benefit is now reduced from $1,200 a month down to $200 a month. And any survivor benefits, which would have been $2,400, are reduced down to $1,400. Now let's say the husband waited till age 70 and claimed their benefit, and it was increased up to $3,168. If that surviving spouse was to receive that spousal benefits, again, $1,000 would be reduced from that monthly survivor benefit, and it would go down to $2,168. So essentially, the key takeaway is the government pension offset would impact any spousal or survivor benefits you're receiving, and the amount that's taken away is 2/3 of the pension that that individual would be getting. So as we're nearing wrapping up here, let's just take a couple minutes to talk about the Social Security statement. A lot of people look at their statement that they get, and it can be a little confusing. But what they basically do is they'll always show a record of all of your earnings over time, and they'll show what your potential projected benefits could be at age 62 and at full retirement age and at 70. But the key takeaway there is at any given time when they're showing what projected benefits would be, they're assuming that you would continue to work and earn the same amount that you're working now until that particular age. So if you earn a little bit more or less beyond the years of that statement, then your benefit at that particular age could be impacted, because again, they're always going to look at the 35 years of highest, but when they produce a statement, they're actually assuming that you just earn the same amount that you earned in the most previous year. So the other thing to remember is that the estimates are always shown in today's dollars, and Social Security benefits can increase for inflation each year. So it's important to get the most recent statement before we run any analysis to see what you might get from your benefit. And whether your income has changed up or down, as I mentioned, could impact it. And also, from year to year, the same benefit projection amount might be increased by just virtually the cost of living adjustments that are added in each year. So as we're wrapping up here, I just want to go over some important things to think about when you're planning on when you would be claiming Social Security. So even after the new rules, there's still many different claiming scenarios to consider. And a lot of people look at claiming as early as they can, which is age 62. But as we like to say, just because you can doesn't mean you should. It may make sense for you to claim at 62, but it may not. So there's really no one-size-fits-all claiming scenario for every individual or every married couple. So really the recommendation is to look at Social Security benefits within your entire financial plan. And at Stonehearth, we really think it's important to look at multiple scenarios to see what makes the most sense for you, because really there's no strategy that can be right for everyone. As with most things in life, you know, the details really matter, and factoring in things like age differences between you and your spouse, or taxes and life expectancy, all of those can affect the overall outcome. So as we wrap up, I just want you to understand that the key to choosing the right Social Security strategy is to plan carefully and really look holistically at your entire financial picture. And you know, with careful planning, a strategy can be really developed to improve the potential lifetime benefits that you get by structuring benefits to begin at optimal times based on your entire financial plan. So that's really what I wanted to cover today. Amanda, my colleague, was keeping track of any questions that might have been posed during the session. So we'll take a minute to look to see if there were any questions.
Hi, David. Hi, everybody. It appears that we had a little bit of an audio issue here at the beginning, but I don't think anybody missed anything super important there. But if you do have a question, please just use the question bar on your taskbar, and we can certainly get to that for you. We do have just a couple questions, and it looks like you did answer it for this client, but I'm going to read it anyway, just in case anybody else is also wondering the same thing. It is a scenario type question, and it says, I stopped working full-time around the age at 62 in 2014. I won't reach full retirement age until 2018. I have noticed on my annual reports from Social Security that my benefits have dropped. Is this because I'm no longer contributing?
Yeah, that's a really good question. So when the statement was produced in those earlier years when you were still working, again, it did assume that you would continue to work and earn that same amount up until those different claiming ages. So those previous statements made the assumption that you would continue to work and earn the same amount, and then once you stop working, then they just kind of recalculate the projection to those future ages. So the statement, it's key to the statement at any given time isn't saying that if you stop working now, here's what you would get at those future ages. It's actually assuming that you continue to work to those future ages. So once you stop working, they do recalculate, and that's why it would go down.
Okay, we do have another one that's a similar question. It says, I turned 65 in November of 2017. Should I start receiving a Social Security benefit while still working? I understand the reduction of benefits is in effect. Does the reduction of benefits expire once I reach full retirement age?
Yes, it does. So the reduction of benefits would no longer be in effect once you reach full retirement age. But if you do earn over those earning thresholds that I covered, then your benefit could certainly be impacted. But as I mentioned, if any benefits are withheld because you earned over those thresholds, your benefit would be recalculated once you reach full retirement age, and those benefits will then be kind of paid back to you. But the other thing that would come into play is your benefit would be impacted just because you claimed early. So in that case, you're only claiming a little bit early. So your penalty, so to speak, would be fairly minimal, and it still may make sense to claim at that time.
And David, I get one more question, and it's, if someone waits until the age 70 to claim their benefit to receive the maximum amount, will their spouse receive 50% of that benefit if they claim a spousal benefit?
Oh yeah, that's a really good question. That's fairly common. So if one individual waits till age 70 and they're now getting their maximum benefit, the spousal benefit does not include delayed retirement credits. So let's say an individual was going to receive $1,000 a month at age 66, and they waited till age 70, and now they're going to receive $1,320. The spousal benefit would only be a maximum of 50% of that 1,000, not 50% of the 1,320. So if a spouse claimed that spousal benefit at their own full retirement age, they would receive $500 a month, even though the other spouse had received a higher amount.
Looks like that's all I have for now, David, but just to remind everybody, if you do have questions, you can certainly email myself or David, or if you'd like to give the office a call, we can set up a telephone appointment to go over your personal financial situation. And I think that's it for me.
All right, thanks very much, Amanda. I appreciate your help. And for everyone listening, thanks for joining today. And on our website, stonehearthcapital.com, we do post our webinars and an article or a white paper for each of the topics that we cover each month. So under our education tab, we list the webinars that you can either listen to or register for ones in the future, and the articles that pertain to each of our monthly topics. So thanks again for joining us, and we hope to see you again on one of our future topics. Take care and have a great day. Thank you.